Good morning and an early Merry Christmas from everyone here at Blackfinch. Welcome to December's edition of the 10-Minute Market Forecast. My name is Josh and I'm Blackfinch's product specialist for our listed investment solutions. And I'm joined today by Gareth Deacon, Head of Multi-Asset. And we're here to talk all things financial markets, and it's my job today to give a quick recap for the month of November. And afterwards, I'll pass the baton over to Gareth, who's going to highlight some points that could be potential market movers to finish off the year and also get us ready for 2024 and the outlook ahead. So as always, please feel free to use the Q&A box at the bottom of your screens and we'll try to answer them if we have time. If not, don't worry, we'll reach out after today's webinar to address them. So let's get stuck straight in. As we all know, markets have been particularly volatile this year in comparison to historical averages, and it's been a bumpy ride for investor returns in 2023 as the months ticked over. And this was mostly felt in the equity portion of an investor portfolio, but also government bonds, especially in the US, have taken a beating. But when the calendar turned to November, everything changed. We ended the month with the S&P 500 being up a near whopping 9% in US dollar terms for the period, as well as some of the small and mid-cap areas rallying off the back of November's events, such as the FTSE 250 posting an impressive 7.5% return. So you'd ask, why such a global market rally? Well, it's much of what we've said in previous editions through interest rate expectations and inflation. But if we start in the UK, the Consumer Prices Index rose by 4.6% in the 12 months to October, down from 6.7 in September, and UK investors are really happy to see this. And I mentioned in the November edition that we could see some of the names rally if we get that positive inflation surprise, and it's encouraging to see that come through the data since the smaller to mid market cap has been somewhat hammered over the years. We also had the autumn statement presented, and there wasn't anything too material that shook markets, and it was much more well received than Kwasi-Kwarteng's attempt last year. And over in the US, what really fired investors up was a set of payrolls data, which showed that the pace that the US economy is adding jobs has slowed down quite markedly, as well as strong GDP growth and falling inflation. And all of this has really encouraged investors who've been sitting on the fence all year round thinking, are we there yet? Is the Federal Reserve finally finishing raising rates? And it's given enough confidence for people to think maybe they actually are. And the mood music from the Fed itself has been, yes, we're going to tread carefully looking forward as we've been aggressively raising rates really hard and really fast. And maybe it's time to sit back and take stock of the impact so far. And this comes back to a house view at Blackfinch, that central banks have adopted that wait and see mode that we've mentioned before. And for investment markets, it really changes the outlook in their eyes. And it's important for investors to monitor the comments from central bankers, as it can give some insight into what they're thinking. And if you cast your mind back to July this year, you'll remember investors thinking we've hit peak rates, markets rallied sharply, but Fed Chair Jerome Powell spoke out and he calmed all of the excitement right back down and said rate hikes were still on the agenda. And we saw the subsequent sell-off straight after. Now, we've seen Jay Powell do something similar, and he stated he's ready to raise rates further, but it's come as less of a shock as we're much further down the line of the rate hiking cycle. So the Fed is almost letting markets price in rate cuts for 2024 because we're seeing that downward trajectory. And not to steal Gareth's thunder too much, but we have seen some cracks in the global economy caused by higher interest rates. And investors could almost be unfurling the mission accomplished banner too soon, because yes, interest rates could drop, but it doesn't mean that we're clear of a recession just yet. And this is why we're seeing Jerome Powell be very careful with his actions and what he's saying. And if we quickly play the scenario out in our heads, if the Fed does cut rates sooner than expected, it almost sounds good, is higher interest rates typically hurt stock markets and they push up bond yields. But think, why would it cut sooner than expected or than is needed? Really, they'll only do this for a very good reason, and that could be problems with the economy. Right now, the equity markets seem to think that the Fed is going to achieve the impossible and magic up that Goldilocks soft landing scenario. And this is where the market rally has come from in November. And it has actually been dubbed the everything rally now, as assets across the board have shot up on the bet that we're now at peak rates. But as history tells us, markets don't always quite get it right. And looking away from the US and onto Europe, we've generally seen some good trajectory for many countries in the Eurozone, with one key outlier. Firstly, Eurozone inflation came in at 2.4% year on year. It's an important print as it's a decline from last month's 2.9, but more importantly, we saw it beat economists' forecasts of a fall to 2.7. And that touches on the point I made last month on inflation surprise. It comes much lower than expected, and markets absolutely loved the print. And we saw that when we looked at the FTSE Europe ex UK index, which rose nearly 6.5% in November. But there is an outlier, which is proving to lag its peers, which is Germany. And we actually saw the court ruling come through of an accounting trick that the German government had done over COVID, where they essentially took 60 billion in euros raised in loans to tackle the COVID crisis, but they repackaged the money for a fund that focuses on green energy projects and industrial transformation. Now, of course, this is going to a good cause, but it's still considered illegal due to its nature, and it creates a big headache for the current government as they have to redraft their spending plans. It's also somewhat humiliating for Olaf Scholz, who's the Chancellor of Germany, as he was the finance minister at the time, and it's essentially his idea, so there's no way he can hide from it. The budget crisis will knock on to their economic weakness, which we're already seeing come through in the data. And all of this was because Germany wanted to catch up with the other green economic powerhouses like France or the US. But it really puts a question mark on Germany's economic model and what this means for the longer term. And touching on China very quickly, we saw a record number of people default on their debts since the COVID outbreak. 8.5 million people were blacklisted for defaulting on payments. This is up from 5 million, which were the pre-COVID figures, and they're largely in the 18 to 50 age category. And I'm sure it comes to no surprise that China was the only area that posted negative returns. And we've touched a lot on China in the past, as it really was an economic powerhouse with the potential for significant economic growth. But this underscores the troubles we've been seeing in the economy, as we have the property sector slowdown coming through with high levels of credit risk and defaults, lagging consumer confidence, deflation, and generally an inability to bounce back from the lockdowns. So this is one area especially that our investment team are looking at. But I believe that covers everything, Gareth. So over to you for the forward-looking points.
Thanks, Josh, and morning, everyone. Thanks for joining us. I'm just going to pick up pretty much exactly where Josh has ended there, which is China, and what's going to make things change. You know, Josh said an everything rally in November. It was an everything brackets except China rally in November. So essentially, what needs to happen to make things improve in China? Where are things going to get better? A lot of what Josh has touched on there is focused and essentially caused by the issues in the property sector. It's a key driver of what's going on. When we're talking about defaulting debt and we're talking about consumer confidence, one of the reasons for that is that 2/3 of private wealth is tied up in property. So property values, falling and defaults across the sector is causing a headache for everyone. It's not just for the companies in that sector. And the government need to step in and do something. They need to make a significant step to shore up that financial system. Up until this point, a few tweaks here and there, try and stimulate some growth, but nothing large enough focused on that property sector. But they're faced with somewhat of a sort of moral issue. They could step in and take all that bad property debt onto the government balance sheet, and they've done that before. But why bail out those companies that haven't abided by the rules that are imposed on them? So the Chinese government are really stuck between a rock and a hard place on this one. And we know that they're going to have to do something at some point. But the question is, and this is the really difficult one for investors now, when? We know Xi Jinping, he came out in October and he said this before, but in October he said a sharp slowdown in growth and lingering deflationary risks won't be tolerated, as the government was increasing its headline deficit to the largest it had seen in 3 decades. And yes, growth in the country has weakened, but is it at that point yet where the government are going to say, we've got no choice, we've got to move and we've got to do something? So it's going to happen. It's going to have to happen, but could it be weeks? Could it be months? Could it be years until we get to that inflection point? And that's what we're kind of battling with and trying to foresee as best we can at this point, to see when we're looking at our focus on China, are we best to keep that exposure now or increase or decrease? So that's something we're battling with. This morning, just to add to that headache, shall we say, we've seen Moody's downgrade China's sovereign debt from stable to negative. They've retained the long-term rating of A1. So still comfortably in investment grade on Chinese sovereign debt. But again, just playing into that point of, are the government going to take all that bad debt onto their balance sheets, which will obviously destabilize the country's deficit problem somewhat. So that's China, something we're watching really closely. I'm going to touch on 2 other things, which are questions I've been speaking to advisors about recently, questions that keep coming up. One of them is next year's elections. I appreciate this is supposed to be a 10-minute market forecast for the next month, but this is a question we're getting a lot, so I just want to touch on it briefly. We've got a lot of elections coming in 2024. If possibly going to be the biggest year in history for the sheer amount of countries going to the polls next year. Currently, over 40 countries are going to be having elections next year, from the US to India to South Africa. I could go on, obviously. And that number's going to grow. We know the UK must go to the polls before the end of January 2025. And the questions we keep getting are, elections have caused instability and volatility in markets before. Is it going to happen again, especially in the UK and the US? Probably not as much as it has previously, in reality. We look at the key drivers of markets when it comes to elections, and it's the main impact tends to be that differing fiscal stance from the competing parties. And depending on who gets in, obviously, that's going to have an impact on the economic growth and deficits. Given that deficits look quite as poor as they do in both countries at the moment, it's going to minimise the potential fiscal policies that parties can bring to the table when they're fighting over power. It's going to minimise the amount of tax cuts. It's going to minimise the amount of spending that can be promised. So it's going to drag fiscal policy from both sides, both in the UK and the US, and globally, really, towards a more neutral ground. So we think actually the potential impact of markets, therefore, of the election of elections next year is going to be minimised. Obviously, anything could happen. We could be seeing Donald Trump running the US from a jail cell. Who knows? But let's not say that there's no black swan events in these things. But base case at the moment, elections shouldn't be a key driver of volatility. The other question I'm getting a lot at the moment: are we going to get a Santa rally this year? I'm sure you're all aware Santa rally there's an apparent tendency for equity markets to increase in the run up to Christmas. Some categorize that as the whole of December, others just the 3 or 5 days before Christmas. But actually, in reality, if we look back at the MSCI ACWI over the last 10 years, the All Countries World Index in sterling over the last 10 years, there's very little sign that Santa rallies actually exist or occur. So it's this kind of this thing that's stuck in people's heads, but in reality very rarely comes to the table. In fact, the biggest December increase we've seen in the last 10 years was 3.3% in December 2016. Are we going to get one this year? That's going to come down to the central banks. And that leads me nicely on to the dates to look out for the diary this year, because 13th and 14th of December this year, we get the US interest rate decision, we get the UK, and we get Europe. So US on the 13th and UK and Europe on the 14th. Basically, we're not going to see any move from any of them. So what we're looking for is that rhetoric. What are they saying? Josh has already talked about how Jerome Powell could have so much impact on markets just through what he says. And that is going to be the determining factor on whether we see a Santa rally, we believe, this year. Other dates to look out for in your diary: 8th of December, US unemployment expected to stay stuck at about 3.9%. And then inflation. In the US, inflation numbers coming in on the 12th of December. We expect no move on core inflation, or sorry, the forecasts are no move on core inflation at 4%. Headline is forecast to drop a little bit, 3.2 down to 3.1. UK inflation's not coming out till the 18th of December, and we're a little bit too far away at the moment to see any sort of general consensus on forecasts at this point. But as I'm sure you're all aware, anything below forecast as we get nearer the time will be very welcomed by markets. And as Josh pointed out already, the numbers in November proved that fact. Apologies, we've gone a little bit over time. One other thing I'd like to flag quickly: the 10-minute market forecast in January, always the first Tuesday of the month, except in January, because the first Tuesday of the month is the 2nd of January, and I don't think we'll get many people turning up on the first day back at 10 to 9 in the morning. So we've pushed that back a week. So if you want to join this call next month, it will be on the 9th of January rather than the 2nd. That should have been adjusted in your calendars if you've got the recurring reminder set up. That's all from me. So I'll just hand back to Josh to wrap up. But again, thanks for joining. And if I don't speak to you all beforehand, have a fantastic Christmas.
Yeah, thanks, Gareth. Should you have any questions off the back of today's content, please contact our dedicated support team, which is strategicteam@blackfinch.com. That's strategicteam@blackfinch.com, and we'll endeavour to get back to you. But as Gareth has already said, a very Merry Christmas from everyone here at Blackfinch. Enjoy the time away and not looking at markets, and we'll see you all bright and early in the new year. Thank you very much. Take care.